Good morning everyone. Welcome to Officer 24/7. My name is Niharika Walia Bhatnagar and I'm with you with the area of ABFM, and we were doing the module C, and in the module C we had started with the topic of discounted cash flow valuation. Discounted cash flow valuation is a specific method under which we find the time value of money of cash flows, है ना? That is required. If we don't do that, how will we actually find out whether the money that we are using would be helpful for us or not? The context of using time value of money is that we have future cash flows, we do not have present, and then from the future cash flows we have to find the value as per today, right? If we have to find the future value as per today, then obviously we cannot find the futuristic value without adjusting it, and that is what the discounted cash flow valuation talks about. What is the primary source of cash flows for equity investors in public traded companies? Interest payments, dividends, principal payments, or preferred dividends? What would be the answer, everyone? First question. Primary source of cash inflows. Sorry. Is it interest payments, dividends, principal payments, or preference dividends? When we talk about equity now, equity gets dividend. So in this case, the correct answer is dividends. Acha everyone, if you like this particular series, then please like it and share it among your peers as well, because I think this is a source of motivation for any faculty who's working on these entire series. We are covering the entire syllabus. If you have seen, the module A is complete, module B is also complete, and currently we have just started with module C, and we are on the second chapter of the module C. And first of all, the most important thing I should say is save the particular playlist of the entire series, so that you would remember that the entire modules are covered chapter wise in this series, right? So on the last day you can just look at all these questions quickly, or just a day before the 2-3 days before the examination you can revise this portion, right? Now look at this question. The financial models that use dividends are known as FCFE discount model, FCFF model, dividend discount model, or cash flows to equity model. Dividends are given to the equity, so technically this is dividend discount models. What is the portion of dividend that people are going to receive over the period of time? Because these people receive the dividends, na? Equity shareholders share in the business is always dividend. There is nothing else that helps them, isn't it? Okay, the financial models that use dividends of cash flows. Oh, we are just done with this question. Dividend discount models is the answer, है ना? अच्छा, next question. What does FCFE stand for in finance? Free cash flow to equity, financial cash flows to equity, firm cash flows to equity, or future cash flows to equity? When we talk about FCFE, this is free cash flow to equity. मतलब after making the payments to all the others, मतलब debenture holders has to be paid, preference shareholders has to be paid. When all these people are paid up, then whatever is left is kept for equity. ठीक है? Then it is called FCFE. And when we talk about FCFE, we are looking at it over a period of years. And then we will measure the same point, NPV, find the net present value. Once you find the net present value, you can find out whether it is helpful for this organization or not. If it is positive, then accept. If it is negative, then reject. Next, how is free cash flow to the firm calculated? Subtracting interest and preferred dividend from net income, adding FCFE and cash flows to the lenders, subtracting net investment required for growth from after tax operating income, and subtracting dividends from net income. How is FEFE to the firm, everyone? this is FCFF. Oh, this is free cash flow of the firm. Well, this is the money that the entire organization is making, not to the equity only. Na? In this case, they are considering the entire organization. So in this case, what do? Preferred interest and dividends are not removed. So this is wrong. Adding FCFE and cash flows to the lenders, no, this is after the payment to the lenders. Subtracting net investment required for growth from after tax, acha, this is true. You will keep a part of it for reserves and surplus, you know, whatever you want to keep. In our book it is written as internal accrual. The answer is subtracting the net investments required for the growth from the after tax operating income. Operating income is the income that the business is making. है ना? So this is operating income. Next point, why might the cost of debt be lower after tax are taken into account? Simple reason, everyone. You take a debt. You start making your project for which you have taken the debt. This will increase your income. You will still just have to pay the fixed rate of interest. He cannot say that, Array, you have started making so much of money because of me. Give me more money. He just cannot say that. You know? Now, I take a debt. The project started. I made good income. And from this income, there is no role of equity here. But the company has started making a lot of income. And this is where equity is going to expect that where is my increased share. Because now the company is growing. If the company is growing, I have the right to receive the money in future. So if I have the right to receive the money in future, I should be given that preference. Interest expense are deductible from tax income. है ना? Then dividends are deductible from tax income. Debt is not subject to taxation. It is subjected to taxation. This is obviously wrong. Principal payments are deductible from the taxable income. No, this is not the point. But the interest is allowed. In this case, what happens is, first of all, we just have to pay the interest. And that too, we can cry in front of income tax department, hi, this is an expense. You pay good amount of dividend to equity. Then even equity is indifferent. This is still not an expense. So isn't it better that we take debt where we get the benefit of interest and expense and we don't have to pay more if the income goes higher, right? So the answer here is interest expense are deductible from the taxable income. If the income increases, the debenture holders will never cry about it, that we need more money. They just know that other than the loan, they have no other right. But the exceptional case is equity. Equity is going to come after our lives, that they need their money. है ना? Equity shareholder will not leave the organization. How is diversifiable or market risk used in estimating discount rates for investments? It is ignored in discount rate calculations. It is used to estimate the risk premium. It is used to calculate the cost of equity. It is considered in determining the cost of borrowing. What would be the answer, everyone? It is a non-diversifiable or market risk. If it is a market risk, the market risk is something where you get risk premium on it as well. For this, they use the CAPM model, capital asset pricing model. Then, under this model, you receive a risk-free rate of return. This is the minimum that you're going to receive, plus your sensitivity analysis. This is beta, your multiplier, and then we have your market rate. You remove the risk-free rate. This is risk premium. This portion is called risk premium. It is used to estimate the risk premium. How is the cost of equity calculated according to the models which have been discussed? Okay. By considering only the risk-free rate, by adding a premium proportional to market risk to the risk-free rate, by subtracting the risk-free rate from the expected return, or by ignoring market risk in calculation. How can we find it, everyone? So we have just did that part. If you take risk, then you will add the premium. Achha, isn't this the same question? No, similar. This is actually similar. By adding a premium proportional to the market risk. Always remember, higher the risk, higher is the return expected. That is the only reason people put money into risky organizations, because they have expectations that they will soon be receiving more money. Otherwise, why would someone put money into something where it would be difficult for them to earn? What is fundamental concept of valuation that analysts should adhere to? Ignoring market values, indifference between purchasing and selling an asset at fair value, using book value weights, or ignoring default risk. What would be the answer? The fundamental concept of valuation. The fundamental concept of valuation is basically the price at which both the buyer and the seller are willing to purchase it. That is what we call the fair value. It means we are looking at both of them. We are not looking at from the point of view of the purchaser or looking at it from the point of view of the seller. We are looking from both the point of views, because one would want to buy, so he would like to pay the least price, and the one would like to sell who would like to pay for the maximum price, isn't it? So that is indifference between purchasing and selling an asset at fair value. What is the challenge in estimating the expected growth in future cash flows? Lack of historical data, uncertainty, predictability of past growth, or market volatility, everyone? What's the answer? What is the challenge in estimating the expected growth in future cash flows? Uncertainty. The problem is uncertainty, everyone. The problem is that the future is so uncertain that even if we want to, we cannot eliminate the portion of uncertainty. You know? So in this case, this is the problem of growth. Done? Next question. Why should the results of growth rate appraisals based on the company management or consensus estimates be questioned? Lack of expertise, inherent bias in the resources, high level of accuracy or transparency issues. What would be the answer? The problem is lack of expertise. Now you get experts. Consensus, basically, people have bias. I think if I don't like the particular person who has been dealing with it, I don't care whether he's right or wrong. I would just impose the fact that according to me, this should not be happening. This is the ideology now. People will impose their ideology, isn't it? This is inherent bias. This is called inherent bias in a resource or in the sources. So while taking decision making, it might turn out to be unfavorable for the organization because it's going to give you wrong results. What potential impact is mentioned regarding rent control to the anticipated growth rate of the cash flows in the real estate? Increase in value, no impact, decrease in value, or stability? The answer is decrease in value. Why? Let's look at it. When we talk about when we are trying to have a rent control, everyone, what will happen? If the rent will grow further at a very higher pace, overall people will try to move away from that organization. This is one particular thing that you will always find. Higher the rent, people are feeling that, Arey, we cannot afford this particular place at all, isn't it? Okay, so that's it for the day, everyone. This is where I'm ending the session. But before I end my session, please go to our website and check out the courses that we have introduced. Go on to the area of Adda 24/7. Let me show you where to go. Just go on to the area of www.adda247.com. As soon as you reach the website, just go on to the area of JIB and CAIIB and open up the CAIIB June 2024. This is where you will find our Mahapacks as well as our Shapat batches and Nishchay batches. Along with this is our bilingual batches. And if you are looking forward towards our batches for the area of scholars. This is our English medium batch. What you need to do is that click on the area of buy now and use the code Y541. As soon as you use the code Y541, you will be able to get the maximum discount. So just click on this, click on apply, you will get it for 5519.77. So hurry up and check it out now.